So today we're going to be running through the Melbourne office market because I think it's a really interesting market at the moment that not many people are talking about. We're going to be comparing the conditions in 2019 to today in 2025, and we're going to be unpacking some of the key metrics like vacancy rates, net rents, and yields. We're going to touch on the price drawdowns in the office market post the interest rate hiking cycle, and we're going to be touching on the narrative of the office market over the last 6 years and potentially the future of the office market moving forwards. We're also going to have a look at getting exposure to the office market, and it's a lot easier than you might think. You don't have to purchase office properties to get exposure to the office market. You can invest in the office market through real estate investment trusts or through unlisted funds. Just as a disclaimer, none of this is financial advice, and I currently don't hold any interests in any real estate investment trusts, funds, and I don't hold office property at the moment. So looking at the Melbourne office market in 2019, this graph comes from a report from Charter Keck Kramer in 2019. And it's basically got the vacancy rate in black going back to January 1990, and it's got occupied stock in blue and vacant stock in orange. So I think in the early 90s in Melbourne, there was a bit of an economic crisis. So the vacancy rate jumped up to over 25%, close to 30%. And then since about the year 2000, vacancy rates have sort of hovered between 5 to 10%. And the vacancy rate was looking really tight towards the end of 2019. We can also look at the CBD vacancy rate by grade. So this graph comes from Charter Keck Kramer again, the same report. So pretty much every vacancy rate of every grade of office space was sort of trending down towards the end of 2019. So really interestingly, looking at market yields for prime space were sitting at around 7.5% net in January 2012, and secondary office yields were sitting around 9%. And yields basically just tightened up towards the end of 2019. So you were maybe getting a yield on prime office space in the Melbourne CBD around 4.75%, and then maybe like 5.25% for secondary office space. So I assume prime office space could be like premium and A grade, and then secondary could be, B grade, C grade. During the time as well, towards the end of 2019, we saw prime and secondary office rents really jump up on a rate per square meter basis. So rents were starting to hit $700 a square meter for prime space, and then around $500 a square meter for secondary space. So basically towards the end of 2019 in the Melbourne office market, we had really tight vacancy rates, rising rents, and sharp yields. I would just caveat that there's a lot of sub-markets within the Melbourne office market, and there is a bit of disparity between all the various sub-markets. But today I'm really just looking at the CBD and giving a bit of an overview. So towards the end of 2019, developers were going really hard on office space. There are quite a lot of projects getting off the ground. And Charter Keck Kramer forecasted that 2020 was going to be a big year for office space construction and delivery. So just some examples of some of the big office developments that were delivered during 2020. We have 477 Collins, which was completed by Cbus in 2020. This is known as the Pants building within Melbourne. It's pretty cool architecture. You've got kind of 2 towers with a bridge across the top, and I think there's a hotel in there and some office space. And you also have 555 Collins Street, which was completed by Charter Hall in 2023. But during 2020, I think construction had potentially commenced. So during COVID, we saw the shift to working from home. And while cash rates were dropped to 0.1% during the COVID era, they were then lifted up to 4.35% in around 2023. So basically the COVID environment just absolutely wrecked the Melbourne office market. In the shift from working from home, a lot of companies cut back on their office space. If you had a lease expiring around 2021, 2022, you'd probably take the opportunity to cut that lease, given that Melbourne was incredibly locked down and there wasn't really a foreseeable future of opening up during that period. And obviously the Melbourne office market was okay when the cash rate was 0.1%, but raising that cash rate to 4.3% had a really adverse effect on the Melbourne office market, and I'll explain why. So say you own an office building and it's getting a net rent of $1 million per annum, and the way the market values this asset is they're applying what's called a cap rate, which is basically a yield of 5% to that rent. rent. So the market sees the asset, they see the $1 million in net rent, and they apply this 5% cap rate to the asset. And that basically works out at a valuation of $20 million. So you just take the $1 million, divide it by a 5% cap rate to get to a $20 million valuation. So if our asset is still achieving $1 million net rent per annum, but the market is now valuing the property with a 6% cap rate because the cash rate is increased, when we divide that $1 million net rent and capitalize it by the 6% cap rate, we're getting to a valuation of basically $16.66 million. So we've seen a reduction in the value of that asset of 17% by the cap rate increasing. So in the years after the cash rate increased, we saw a lot of headlines and a lot of pain in the office market. So this headline's from September 2024 and is from the AFR. Office values dropped 22% in 2 years. When will they bottom? So you can see across the spectrum of commercial assets, retail got hit pretty hard with their cap rate blowing out. So industrial assets, so big warehouses, were relatively unscathed, and that's because there was so much demand. Vacancy rates were so tight and rents were increasing really fast. So although the cap rate moved up, rents also moved up. So valuations stayed relatively stable. The office sector got completely smashed. And a big part of this was the vacancy rate blowing out within Melbourne CBD office space. So here's a headline: Melbourne CBD office vacancy rate touches 20%, which is huge. So this is pretty recent from the AFR in October 2024. And a big part of this is really the rise of remote work and companies still cutting back on office space. So you cut to 2025 now, the vacancy rate in the Melbourne office market is sitting just under 20%, and asking rents on a $1 per square meter basis have come off since the start of 2020. They were sitting around $460 a square meter, and they're now down to around $400 per square meter. You can also see that a lot of space was delivered in 2020, not much was absorbed, and the amount of space being delivered in 2023 and 2024 is a lot less than 2020. And that's purely because why would you develop office space as a developer? And this information comes from Cushman and Wakefield from a market beat report looking at CBD office space in late 2024. So again, you can see that both prime and secondary rents have really stayed stagnant over basically the last 5 years. And you can see that yields started shooting up from that interest rate hiking cycle in 2022. So prime yields went from around 4.5% to around 7%, which is a huge move up. But just going back to this vacancy rate now, I guess there could potentially be some opportunity in the Melbourne market. We're sitting at really historically high vacancy rates, and I'm on the train into the city every day and it's starting to get absolutely packed. And I think workplaces mandating staff coming back into the office on an almost full-time basis is just becoming more and more common. So it's also worth noting that in America, all of the government employees are being mandated to return to work in person. So this comes directly from the White House in January 2025. And we're seeing an increased focus on productivity from government and business in the United States. And I think culturally that will probably filter out into Australia at some point. Even a few days ago, we were seeing Peter Dutton proposing that public servants return to the office. I also just wanted to add that I'm not a particularly political person, and my view is that workplaces probably should provide a bit of flexibility. Probably 2 days working from home and 3 in the office is a good mix. Another headline here from the AFR in February 2025, office mandates stretch towards 4 days, Mondays and Fridays on radar. And anecdotally, I've seen reports of companies not having enough office space and mandating people back to work, and people are working in the kitchen because there's not enough desks. It's just really logical to me that this vacancy rate in office space is just going to trend down over time, and we're potentially seeing a bit of a bottom in the Melbourne office market. I think there still are some economic headwinds, and we've seen lots of industries in a bit of a downturn. The consulting industry has been hammered within Melbourne. There's been a fair amount of redundancies in property, infrastructure, finance, tech. So there are still economic headwinds. opinions and obviously do your own due diligence. So additionally, we've seen the first rate cut finally in February 2025, and it was cut by 25 basis points. So you would expect that this would potentially drive yields and cap rates down within the office market. So that same example before, if you had a net rent of $1 million and a cap rate of 6, you've got a valuation of 16.6 million. If the cap rate and yield follows that interest rate decline and the cap rate's now 5.75% and the net rent's unchanged, then you now get a valuation of around $17.4 million, which represents a 4% uplift. So I'm not an economist, but all the big banks are sort of expecting, I think, 2 more rate cuts this year, which would help bring cap rates down and potentially the valuations of office space up. I thought I would also just touch on how could you potentially get investment exposure to the office market if you wanted to and you thought that this was a good thesis. You could potentially directly invest by purchasing office properties, or you could invest via REITs, which are real estate investment trusts. They're publicly listed funds which basically hold office assets, or unlisted funds, which are basically funds that aren't listed, full of commercial property assets as well. You can get exposure to property via these funds without actually purchasing the property. You just buy the equity in the fund that holds all the property. You don't have to manage it. Also, 100% not financial advice. And I also don't own any office properties at the time of recording this video, and I don't own any REITs at this point in time. I thought I would just have a look at the Centuria office REIT, and all of this data comes from their half year 2025 results. Just running through this as an example of a REIT that has a lot of exposure to office property. So they've got 19 assets, $1.9 billion in portfolio value. The average cap rate, which is basically the yield across that portfolio, is 6.77%. The occupancy of the portfolio is 92.2%, and the weighted average lease expiry of 4.2 years. What I did find interesting from this report is that they're saying that the replacement cost, so basically the cost to develop an office tower, is about $15,100 per square meter, and the Centuria Office Fund COF, that's what it trades on the ASX as. The current, average valuation of the office space within it is $6,850 per square meter. So the value of the asset is sitting well below the replacement cost of the asset. And then additionally, the implied trading price valuation is $5,700 a square meter. So I think that's basically saying that the fund is trading at an implied discount to the market value of the assets within the fund. Also, just to keep in mind, I'm not a fund analyst. I'm not particularly good at analyzing equities. I'm a valuer by trade, so I understand the assets within the fund, but I don't have a good grasp on how to actually value the fund and the shares of the fund. You can also see from this document that they've outlaid a basic rundown of all the locations of their office space. They've got the vacancy rates and the 12-month rental growth. So you can see that Brisbane is actually doing quite well compared to the rest of the market. They've got vacancy rates of 11 and 13%, and they've had quite large 12-month rental growth, 8.5% for the CBD and 10.3% for the Brisbane fringe. So that signals to me that there's quite a lot of demand for office space within Brisbane at the moment. Within the report as well, they have an appendix showing the actual properties in the portfolio. They've got the book value of those assets and the capitalization rate as well. So you can see I've just highlighted a few of the properties in there. Looking at some of these Melbourne assets, we've got 818 Burke Street Docklands, and that's still only got occupancy of 73.7% and quite a high cap rate as well. Knowing the Docklands market, it doesn't perform particularly well compared to the Melbourne CBD. It's a bit of a transport dead zone and a bit of a secondary office market. So yeah, I'm quite interested in Melbourne office space at the moment. I'd like to do a bit more due diligence around some of the funds and ways to get exposure to the Melbourne office market without potentially purchasing an office property and having to manage that asset. I made this video just because I'm interested in the Melbourne office market and not many people are really talking about it at the moment. and not financial advice. Leave a comment if you'd be interested in more breakdowns of commercial property markets rather than just analyzing resi like most of the videos on my channel. Thanks.